All right. Hello, everyone. Welcome to another episode of Saka's Is That So? I'm really excited to be speaking to Darius Dale today. He is the CEO and founder of 42 Macro. Very interesting name. And if you haven't heard of Darius or 42 Macro, I'm sure you'll be hearing about them very soon. Welcome to the show, Darius.
Saka, it's a real pleasure to have you, man, or beyond, man. Thanks for having me.
Of course. Well, why don't we jump straight into things? What is your current assessment of the economic environment globally today? How you see it from your purview?
Ooh, so that's a loaded question. So look, whenever you're talking macro, I think it's really important. And this is, comes back to my background as a sort of institutional investor. It's always very important to understand sort of A, what you're talking about, but B, most importantly, talk about the things that matter the most. So when you talk about macro, there's really three big things that you need to get right in macro that really matter. One is the growth cycle. Is growth accelerating or decelerating? Is it above trend or below trend? Same thing with inflation, accelerating or decelerating, above trend or below trend. And then lastly, how do those two variables coalesce to kind of influence policymaker decisions? And right now we're sort of in this sort of perfectly bearish cocktail if you think about all those three variables. One, we have growth, the transition, we're slowing from a growth perspective, and we're going from above trend to below trend, at least in a reasonably forecastable horizon. And we're currently are starting to decelerate on inflation. Sorry, we believe we're starting to decelerate on inflation. We economists have been wrong-footed on that for quite some time now. But the reality is, if you look at it on a headline basis, inflation is now starting to roll over. Different pockets of core still actually accelerating and building momentum to the upside. But let's just assume we're talking about headline inflation. Headline inflation is now starting to decelerate, going from above trend to below trend. And because inflation is above trend and because growth is still not yet below trend, you still have a really negative policy mix, particularly as it relates to Federal Reserve, European Central Bank, Bank of England. All these major central banks are very actively engaged in tightening policy, many of which are tightening policy at the fastest rates we've seen in 30, 40 years. So it's quite negative. The outlook doesn't necessarily get any better anytime soon, unfortunately, but I do believe there are ways we can sort of stomach weather the storm, if you will, as investors.
Absolutely. And I love the fact we're having this conversation because it's sort of where the big picture macro meets the operators and the VCs and the people that are in the weeds. And from our perspective, we hear the headline of interest rates going up. And from a practical perspective, to us, that means our cost of capital is going up. It means that our forecast in terms of what startups or what investments are profitable are changing because our net present valuation calculations and all that stuff is changing because we have to factor in the inflation. And in a low inflation environment, we've forecasted out very, very far in the future, and investments made sense in that environment over the last 12 years. But now we're having to recalibrate and focus more on companies that are profitable, and things of that nature. And so from our perspective, the world has really kind of gone upside down. From our perspective, how far can we expect interest rates to go up? Because what we're hearing is that they should go above the CPI or the core inflation, which is like 8 or 9%. And for us, that would almost break our model in so many different ways. So, I mean, where should we set our expectations? Should we expect that, or where are we tapering off? How should we think about it?
Fantastic. So the short answer is no. We're not going to get interest rates up to that level because we won't have to get interest rates up to that level. We're already starting to see inflation momentum break down. And what I mean by momentum, if you look at it, the statistics on a month-over-month annualized or 3-month annualized rate of change basis, we're now already kind of in the, let's call it 5 to 6% range. And so if we continue to slow, at least over the next couple of quarters, it's likely that inflation momentum will be somewhere in the 3 to 4% range, which by then will likely have observed interest rates higher than the reported inflation. You said something to me that I think is really important to unpack for not just operators but investors, everyone. When you're in a higher inflation regime, and we've proven this empirically with our data at 42 Macro going all the way back to the 1800s. When you have higher inflation, you tend to be in higher inflation volatility regimes, i.e. the realized volatility of inflation is actually higher when inflation is higher. And the issue with that doesn't necessarily, it's not bad in isolation, but the problem with that is it makes it much more difficult to forecast and invest capital in any economy. And what tends to happen as a function of that which we also can observe empirically, is that you have higher volatility in both nominal and real economic growth, right? If you have higher inflation volatility, higher volatility in nominal and real economic growth, it turns your entire world completely up on its head, right? It's so much more difficult to capitalize businesses and understand what the cost of capital or what even the cash flows are going to be in that type of scenario. So I think the whole world is, we're dealing with the regime change. I think you kind of alluded to this, which is we've been in this world very disinflationary. We didn't really have to concern ourselves with, the net present value of cash flows, or sorry, we never had to concern ourselves with pulling cash flows forward into the present. We could just sort of, discount them forward into the future. And that, in our opinion, at least according to our models, that world we've exited that world. We are now in a structurally higher inflation world. Our maths, to be specific on that, we built this very sophisticated dynamic factor model that takes into account 16 different variables that have various relationships with inflation from a co-integration and correlation perspective. And that model is suggesting that core PCE, which is the Fed's preferred inflation metric that strips out energy and food, that model suggests core PCE on a trend basis should be around 120 basis points higher. And so that doesn't sound like a lot, but that's almost double relative to what it trended at the previous decade and this decade of low interest rates, sort of permanently high asset valuations.
Absolutely. I'm going to come back to sort of the way that measured inflation, because from our perspective, it's kind of ludicrous that the Fed would remove things like housing and food. Like, isn't that the biggest problem?
If you strip out housing, food, medical costs, and energy, then there is no inflation.
I mean, it's kind of bonkers. We're looking at that, and there are economists that look at, I can't remember the name of the actual way of measuring inflation, but they use ones used in the 1970s because they want to get an apples to apples comparison. But just the way it's measured is a bit wonky to some of us on the outside looking at it as regular consumers. I don't know if you can share any light on why they use these types of metrics and exclude certain ones. Do you think that's the right way to measure it, or?
So I tend not to get into is this the correct way of doing things or not, because at the end of the day, we're market practitioners. So it's my job to help our clients make and save money, right? And they're either it's their money or it's their clients' money if they're hedge fund or mutual fund. So at the end of the day, what we're really trying to focus on is, okay, what matters? How are the things that matter going to change over time? Can we forecast those things? And then if we can, let's build sophisticated models that allow us to forecast them accurately with consistency. That's really what we care about. But to answer your question, in terms of CPI methodology, it is wonky, and it's a funky construction, because one thing that happens with the CPI specifically is that there's a lot of substitution that happens in real time all the time. So let's say, prices, I don't know, spaghetti shoots up, and so the Fed decides to substitute rigatoni instead of spaghetti in the basket. That stuff happens on a month-to-month basis. You go back and look at the index construction in the 1970s. That construction was based on what they assumed the consumer, the sort of median consumer was spending their share of wallet back then, which obviously has changed and evolved over time. I mean, we have things like iPhones and sort of self-driving cars now that might not have been in the basket back in 1971. So there is some reason, like just fundamentally for why it's changed. But to your point, there is a lot of sort of, I wouldn't say shenanigans, but I think if you had a more tinfoil hat view of the world, you could call them shenanigans, because again, don't forget the government's Social Security payments are indexed to CPI, as are tips, the Treasury Inflation Protected Security. So like the government has a vested interest in reporting a lower level of inflation that is actually occurring in the real economy.
Absolutely. And kind of understanding the regime change that we're going under that you mentioned, you look at long-term and short-term debt cycles. I recently read Ray Dalio's book on, the changing world order. So we're trying to make sense of, all right, how do we forecast and think about the next 10 years? Where are we in sort of the long-term or short-term debt cycle? Is it so cataclysmic in terms of we're about to go into another 100-year period that's very different from the last 100 years? Or is it just a 5-year temporary change? Like, where are we in kind of the grand scheme of things?
So I study Ray's work pretty religiously. In fact, I built our core forecasting model based on their all-weather system. So I'm quite familiar with Ray's work. I will say that I hold him as high regard as any investor in the world, but not even Ray has a view on what's going to happen 100 years from now, right? Like, let's keep all this stuff in perspective. We can identify different things like the short-term and longer-term debt cycles and try to ascertain based on various metrics. And again, we never have perfect data as economists or investors. We can try to ascertain where we might be in these cycles, but the reality is none of us has a great track record of forecasting things 10 years, 20, 30, 40 years in the future, right? So let's humbly accept that and just deal with the world as we see today and how some of these variables might change in a more predictable, stable manner. As it relates to the sort of, in terms of our view on the world from a longer term perspective, to me, I think the biggest issue we need to be asking ourselves as investors is what is the Fed and other central banks as a function of that going to do in response to this higher inflation world? Right? Because we're currently in a regime where the Fed is very clearly trying to get inflation back to its 2% mandate. But if you mentioned, I mentioned earlier that our model, and again, this is not, our model could be wrong, could be right, who knows? But our model is at least saying that on the higher end of our projection range in terms of the underlying trend of inflation, it should be somewhere around 3% on a trend basis, which means the Fed's going to have an awfully easy time to get inflation from 9% to 3%, but it's going to have an extremely challenging time to get it from 3 to 2. And more importantly, is it going to persistently try to get it from 3 to 2 throughout this entire decade? And if that's the case, we're going to be talking about a Federal Reserve whose policy is persistently tight and is consistently leaning against the market, which is basically a reversal of what we had in the previous era, which is a Federal Reserve that was consistently easy and is acting as a consistent tailwind to the market because inflation was undershooting their target. So I happen to have a view, and again, this is where becomes less quantitative. We pride ourselves on being very quantitatively oriented investors. This is what becomes less qualitative and more qualitative. I have a view that when we get to that point in the process where we have to make these sort of very difficult trade-offs between higher unemployment and an additional 100 basis points of disinflation, I think the Fed is going to capitulate. I happen to think Jay Powell would much prefer the unemployment rate to not go to 7.5% from, let's say, it'd probably be 5 at that particular point in time. I think they would much rather have they'd much rather have that 250 basis point increase in unemployment and sort of avoid that, if you will, as opposed to having that additional 100 basis points of disinflation. So I think you have to have a view on that, by the way, as an investor to get this next, let's call it 3 to 5, 6, 7 years right as an investor. Because if you have a different view on that, i.e., they're not going to capitulate, they're going to hold the line as they told us last Wednesday, then it's going to be a much more challenging environment to operate both a business and to operate in as an investor.
Absolutely. And one of the things I look at as an investor as well is the different markets that we operate in. So I make UK investments, and on the plus side, UK investments look cheap because the pound has literally fallen off a cliff over the past couple of weeks, if not months, right? Which means they're cheap. But at the same time, if I invest in a company there and the revenues are going up, ultimately, the revenues have to outpace the devaluation of the currency because I have to put back in US dollars and things of that nature. In fact, there was a recent FT article that showed that the UK was operating almost like an emerging market currency in some regards. So I'm just thinking about how we think about the sort of macro environment from a emerging versus established markets, or should I say developed market perspective, and how we can navigate that as investors to ensure that we are picking growth markets with currencies that will help us report back in US dollars ultimately to our investors or our LPs in a sort of positive way. And we're not looking at today, we're looking at exits in 5 to 7 years time in the VC landscape at least. So do you have any view on 5 to 7 years time, what currencies will be devalued, which ones will hold their value, how we should even think about that perspective of investing?
Yeah, great question. So I love currencies because currencies are that's macro, right? 101, right? Like, but most of our, just as an aside, like most of our audience, at least on the institutional investment side, are equity and credit fund investors, or they invest in global fixed income. But very rarely do you get a chance to really just talk currencies, right? That's the old school, like global macro focus. And so this is a topic that's been a long passion of mine. I will say this just before we even unpack this discussion. I think as a venture capital investor, or someone who's investing in private markets, if a currency is a material component in that decision tree, it's probably because you're looking at the wrong countries and the wrong businesses, right? If you're trying to exit 3 to 5 years from now, 10 to 15% move into currency should not have much of an impact on your IRRs. In my opinion, I think if you're picking the right businesses, obviously, if you're picking the wrong businesses, then that would be a material function. But generally speaking, like in my opinion, I think you can generally write off currency movements over a long period of time because, again, the means are going to be fairly stationary. Now you're going to have currency cycles. Right now, we're in a very strong dollar bull cycle. and dollars, historically strong versus the euro, historically strong versus the British pound, historically strong versus the Japanese yen, and is getting to a point where it's starting to become historically strong versus the Chinese yuan. The things that tend to drive these cycles longer term, and I've seen dozens of different models that try to sort of project exchange rates, and some work sometimes and some others work other times. The reality is there's not one particular model that you can use to say, hey, okay, I expect XYZ inputs to accumulate to generate XYZ outputs, 3 to 5 years later. The reality is, I think the models that have been the most consistent are sort of the dollar smile theory, which is, when because the world is on a global dollar reserve system, most of the credit that's created in the world is in dollars. Most transactions, cross-border transactions, tend to be in dollars. And so as a function of the world getting better on the right tail of things, the dollar tends to do really strong because, again, the U.S. tends to be a great beneficiary of all that. And on the function of the left tail of things, the dollar tends to be really strong because you tend to have a sort of, let's call it a significant reduction in the supply of dollars available for consumers and businesses and investors to actually access. And that's sort of that's the scenario we currently find ourselves in today. That scenario is also being exacerbated by what I think is a kind of one of the other more consistent models is in terms of like the spread between different countries' policy rate expectations and short-term interest rate securities. The Fed continues to be the leader as it relates to not only terminal rates, but also the speed with which those rates are changing. And so right now, the dollar is benefiting from both higher expected terminal rates in terms of premiums, but also the change is actually faster than what we're observing in peer central banks. That change is going to slow.
Sorry, some of our audience might not know what terminal rates means. Do you mind?
Oh, sorry. Yeah, let me take it back. Yeah, please. My apologies. Cut me off anytime. My apologies. So what I mean by terminal rate is the federal fund. Let's say the Fed is hiking the Fed funds rate. Right now, it's currently at 3.25%. They want it. The market is currently pricing in. If you look at 6-month forward futures for different things like Fed fund futures or Eurodollar futures, et cetera, their market is currently saying we think the Fed's going to get this rate to around 4.5%. So another 125 basis points. So that 4.5% is the expected terminal rate where the Fed will end this particular tightening cycle. And so our expected terminal rates are higher than the expected terminal rates of countries like the Bank of England, the European Central Bank. Obviously, the Bank of Japan's not even tightening. So the dollar's really benefiting from that. But it's also benefiting from the change in the speed of the change in the terminal rate expectations, i.e. we've gone from 2.5% to 4.5% in like 6 months, whereas it's taken 6 months to get the Euro's terminal Fed funds rate to 2%. So we're also benefiting from the speed of that change too, but the speed of the change is going to slow down. And so that you're going to remove one of the positive sort of things that's been very strong and supportive for the dollar over the near term. And that's going to start to cause, dollar weakness, or not necessarily dollar weakness, but you're going to remove a significant reason for a lot of the current people who are long the dollar in the Forex market to start to close out some of their positions. So you roll this forward, let's call it 3 to 5 years from now. The only things that really matter 3 to 5 years from now are the economies, the shape and nature of the recoveries that these economies are going to experience on the other side of what is going to likely be a downturn, in places like the US and Europe. These economies have proven that they have not been able to stomach tightening. And more importantly, history shows you tend not to get, significant drawdowns in inflation, particularly core inflation, unless you go into recession. So we can assume that at some point in the next 3 to 5 year investment horizon, there's probably going to be a recession across most of these economies to have to price in. And so it's the kinds of sort of dynamics like demographics, the capital cycle. Did we overinvest capital in a particular country or particular A? Did we underinvest in particular country, particular A? I think the best combination from a currency market perspective are demographics and places where we have not seen a lot of investment. Right now, the U.S. has seen too much investment. If you look at the last 4 years in particular, through the lens of the change in our net international investment position, which is the amount of stuff that people own, the amount of stuff that foreigners own that is U.S. capital, we've actually sucked in about $10 trillion over the last 4 years, which is like as much as the last 20 years combined. And so that's a lot of money that could go in the other direction in a recovery cycle. So you look for countries that have good demographics, that have had starvation of capital, those currencies are likely to do really well. So I can't name them off the top of my head on the capital side, but certainly on the demographic side, it's all your who's who of emerging markets.
Absolutely. It's so interesting when you mentioned it's the rate of change that's really important. That's something that people don't think about. They think of the absolute, change that happens, but it's about how fast things are changing. And, you look at things like the ISM index and things of that nature, you start to understand the way the world works and really those nuances that matter more than other things. But there's something you mentioned as well, and that I've been thinking of, which is around the fact that the US dollar is what's used in like 88% of world trade. And the US benefits from that, right? Because everyone needs to convert their local currency to dollars to buy certain goods and services. But we've seen currencies like the Russian ruble gain because they are sort of a commodity-backed, quote unquote, currency, right? Because of their oil and things of that nature. Do you forecast or see a world in which the US dollar becomes a smaller percentage of the global sort of reserve currency? And is that necessarily a bad thing? Because if other countries can trade directly with each other or use another medium, what does that mean for the US and what does that mean for the world at large?
Oh, great question, man. So yes, to answer your question, the short answer is yes. The world is already moving towards a multipolar state. If you look at the alliance between China and Russia, that's about as clear an indication that that particular side of the world, or that axis of the world, really does not believe in the sort of the proliferation of the U.S. dollar as the sort of primary medium of exchange, and more importantly, as the unit, the base unit for reserve, status. So China's done a significant, they've really since over the last kind of 6 or 7 years, really since 2015, they've been embarking on a series of measures in terms of issuing international swap lines to peer economies, et cetera, that sort of suggest that they're setting themselves up to, at the bare minimum, be the sort of reserve currency of Asia. Now this will take, if not 10 years, if not 20 or 30 years in terms of actually getting this done. But the reality is he or she who controls the price of the barrel of oil is in control of the game. I mean, that we've learned this, really studying the petrodollar system since going back to the 1970s. And it's very clear that if Russia decides to become a rogue actor with respect to its energy products, i.e. really only selling to places like China or, friendly countries like India, Pakistan, et cetera, Turkey, those are that could really have a real material shift in terms of how much the world needs dollars, right? That's a lot of demand for barrels of crude oil and energy products that if they don't need to be priced in dollars, the dollar, China doesn't need to sit on 3 point something trillion of US dollar denominated foreign exchange reserves. So the key takeaway is what are the implications of all this? And again, this stuff is structural. I mean, you're asking the right questions as a venture capital investor, because again, you guys have much longer term time horizons than I guess us macro guys and us regular equity and credit guys. But the reality is the obvious implications is weak dollar, cost of capital in the US higher. I mean, I don't know what the math is on this, and I'm not sure we can know because there's been no counterfactual to observe. But the reality is we know that the US, which has had a persistent current account deficit, we've not had to have the kinds of levels of interest rates that would allow us to sort of, capitalize those deficits. I think we're observing this in real time of what it might look like, with the Bank of England, with London, in terms of Liz Truss and her economic policies being repudiated by the market. That's the kind of stuff you would expect to see when the U.S. decides to do fiscal stimulus in a world where the U.S. is not the reserve currency. So, it's called exorbitant privilege for a reason. It's kept our inflation down. It's allowed us to access international capital at rates that would otherwise be untenable if we weren't the reserve currency. So for other investors, so I got to believe that as we progress forward in time, the underlying the spread between U.S. interest rates and global interest rates, that current spread as wide as it is now, because we're at the bottom of we're at the top of the capital structure, with the bottom of the interest rate structure, that spread's going to narrow. Our rates are going to catch up to the rest of the world. But again, this is multi-decade stuff.
Yeah, absolutely. I mean, we have to think in long-term horizons, because the actual average time for a company to exit back in the early 90s, it was 3 or 4 years you could get an IPO. Now, private companies are staying private for longer, 10, 12, even 15 years. There are companies that don't exit. So we kind of have to start thinking about macro and forecasting what the world will look like when that exit or liquidity event happens for some of these investments we're making today.
Are those average statistics, or you say you're just highlighting? What's the average now?
No, the average now is about between 10 and 12 years, depending on
what. Are you kidding me?
Yeah,
wow.
It's a long time. Yeah, because companies are just kind of taking in the money right now, making hay while the sun shines. Private market valuations, or some would say distorted versus the public, right? So they want to keep those valuations high and then hopefully grow into those valuations. So when they IPO, the market agrees with the latest valuation. Because what you're seeing now is that the public markets are, depressed, and that's cascading into the late stage private investments, and it's cascading all the way back. So companies want to stay private for longer so they can grow into these, some would say, overhyped valuations, rather than IPO and then see your stock just crumble and your late stage investors just get absolutely obliterated. I can think of so many examples there. But I don't want this to just be a one-way street. I know you had a few questions about sort of VC and startup investing and things of that nature. So feel free to shoot if anything has come to mind.
Well, yeah, it was actually specifically on that process. So it's what I don't understand is, and please educate me on this, is what's the typical time lag between observing something like a 20% decline in the public equity market and actually seeing those haircuts in the private markets? We know that if the public equity market is down, we're going to see a cessation, like a real cutoff of deal flow and capital markets activity. But we might not actually. So when do you actually start to see the marks? Is it, I mean, again, I have no idea. Please educate me.
Yeah, no, I mean, so late stage, you've already started to see those effects. In fact, according to the CB Insights Q2 report of this year, late stage valuations, late stage meaning sort of series E and D and things of that nature, valuations have gone from about $1.1 billion to about $1 billion. So 10% reduction, but it depends on the company you're talking about. I mean, Klarna, which is a huge fintech, went from 75 billion in valuation to like 5, which is not, it's huge. It's a catastrophic fall, but that's a very unique circumstance. We're looking at the median, not the one-offs. So late stage, you start to see the valuations go down. But interestingly enough, the cascade hasn't filtered right the way through to sort of angel and pre-seed, which is the very early stages of investing. Those valuations are actually going up, believe it or not, by 10 to 15%. And I have a few theories why. My hypothesis right now, my working hypothesis, is that after the pandemic, there's been this proliferation of new startups because the world has fundamentally changed in ways of working and things of that nature. And so a lot of VCs are now competing heavily to go into that space because there's so many new ideas. You see Andreessen Horowitz and Sequoias, who were typically late stage investors, are now coming in earlier on. So they've created multi-billion-dollar funds, which means there's more competition for these deals that are happening at the early stages. So that's one of the reasons that I see that happening earlier on. But I do believe it will cascade right the way through. I'd give it another 12 to 24 months to work its way right the way through. But it's a great question to be asking.
I didn't realize the lag was that long.
Oh yeah.
Because I mean, you see you could see it. You pull up with like for instance, you look at Bloomberg and you could see a league and shows you like capital markets activity, IPOs, debt issuances, etc. That stuff is bone dry, for lack of a better phrase. But it's so interesting to me that I guess it does kind of make sense though. Unless companies need money, I mean, they will eventually all need money at some point. But until they say we need money, there's no reason for the valuation to change, right?
Exactly. So a lot of these companies will have 12, 18, 24 months of runway. So until they're pressed to raise, and I'll be honest with you, some VCs don't want to see valuations go down for obvious reasons, right? So what they'll do is maybe a bridge round just to keep the valuation where it is and things of that nature. Yeah, so it's a very interesting game. And also don't forget, we're expecting at the early stages a lot of companies to fail because by nature of early stage investing. So it's kind of like the more bets you put into the race, the more chances you have of hitting that one or two unicorns that'll pay for your overall fund. So it's kind of like, yeah, I don't mind throwing a few extra $100,000 checks here and there because I need one that's going to pay for the entire fund. So the more bets I place, the better my chances are. So that's also why it's a bit different at the early stage compared to the late stage. Late stage is like all your chips are in one or two baskets of big companies that you're hoping to do really well. So it's a bit of a different dynamic.
No, it's fascinating stuff, man. Because it's we have a negative view on the growth cycle. Like if right now, I would argue based on our analysis, a recession is not necessarily the modal outcome, either in terms of with markets pricing in, but also in terms of with the dynamics in the economy. We simply have not seen the kind of build. There's two things that tend to cause a recession. One is an aggressive build up in terms of leverage, debt to income, debt to GDP. If that build up is over a short period of time, like if a 2 sigma, kind of a move over 3 to 5 years or something like that, for instance, that tends to be a warning, like a red flag warning signal for recession. We don't have that in the private sector in the United States. We're basically at like a 0 sigma in terms of the speed of the leveraging that we've done in the last 3 to 5 years. So that's not really a big issue. We have seen a pretty substantial size in terms of the shock. So one thing we also look at in terms of identifying kind of short-term debt cycle risk is just looking at sort of the cost of amortizing debt. Our debt service ratios rising really quickly. We've seen obviously policy rates and interest rates across the curve and credit spreads widen. And so we've seen that buildup. We've had a pretty significant shock. In fact, if you look at it on a real interest rate basis, or if you look at it in terms of mortgage rates, either real interest rates or mortgage rates, the biggest shocks we've seen on a rolling 3-year basis ever in terms of the statistics. We have the data going back to the 70s and 80s for these statistics. So wow, it's a big deal. It's just not as big as a deal as it would be if we also grew a bunch of credit into that, right? Because what you're really saying is we're resetting all the credit to a higher level. All the refinancing has to happen at a higher level, and we're probably not going to have the cash flows to support it. So that process is not necessarily as onerous as it was, let's say, in 2000 or 2007, but it's still not good, right? You have a pretty substantial shock. So it's probably telling you that growth's likely to continue to slow. You're probably likely to have some industries in recession, maybe not necessarily all industries, because again, there's a tremendous amount of cash on consumer and corporate balance sheets. And I'd pose this question to you. Right now, if you look at the aggregated full fund statistics in the U.S., I'm isolating the U.S. in particular, there's about $4.9 trillion of cash on consumer balance sheets, which compares to around 1.2 trillion pre-COVID. So a lot of the excess stimulus that the government spent has found its way onto consumer balance sheets, either through direct, government transfers or through me spending money at your business, and you small business owner now have my money. That's a really high number relative to history. We also have around $2.2 trillion of cash on corporate balance sheets. So to me, I have to add, when I think about like the outlook for the economy, it has to be it can't just be all negative, right? We have this massive interest rate shock, but we also have a crap ton of cash on corporate balance sheets, and there's a lot of cash waiting to collect interest as well. And so I think about it from the perspective of your industry, which is, are companies as flush as they seem based on those statistics? And do you expect what we're seeing from a policy tightening perspective, from an interest rate shock perspective, to really hit the kind of companies that you guys are following and tracking?
Yeah, it's a good question. Well, there's almost $290 billion of dry powder in the VC space. This is record levels. There's never been this much capital available in the VC space ever.
The last time I heard that statistic, it was like 110.
Yeah,
so that's a lot.
Yeah, there's a lot of money available. So that's not the problem. So VCs will be able to fund companies and give them extended runways, but you have to understand that VCs are funding scalable, usually tech-enabled businesses. So the mom and pop stores that are out there, theirs might be very different from sort of tech and scalable businesses, right? So I would really make sure that we dissect and look at within the landscape of consumers or businesses, who amongst them has the dry powder? Because even amongst consumers, I would hypothesize, and I don't know the data on this, but it's like within a certain enclave, maybe it's upper middle class or whatever it is, people that have been able to save, that don't have those daily expenses. Those are the people that have the dry powder, that were able to buy second homes and things of that nature. But a vast majority of people, I mean, Americans, almost 50% can't afford $1,000, unexpected fee that comes up. Those people are really hurting even more. So what I hypothesize and what I see right now is, yes, there's a lot of money, but it'll go towards companies that are sort of best poised to win in the long run. And win here means capture so much market share that the competitors just fall off, or raise enough money from VCs in the meantime. Or B, those that are actually able to show a long-term trajectory in terms of getting to profitability. In the VC space now, we were usually tasked with looking at user growth, right? It was all about how many users can you acquire, and then eventually we'll monetize them at some point. But now the conversation is very different. I want to know how you're going to get to profitability within the next 2 to 3 years, because while I have the dry powder now to invest in you, at some point, the taps are going to, shut off. We are going to see that decline. And I want to know that you're able to sustain yourself, at least, during that time period where things are tough, because we just don't know what it's going to look like. So long story short, I just say, yes, there is a lot of dry powder out there, and there is, consumers, or there are consumers and businesses flush with cash, but it depends on what part of that spectrum you fall on, to a significant degree, to be honest.
Yeah, great question or great response, man. Because you bring up something I think is very important to highlight, especially now in this American economy, which is the distributional aspects of this entire experiment, if you will. Monetary policy is going to be, I would argue, fiscal policy is even more of an experiment at this point. The distributional aspects are huge now because we've exited an era, and I happen to believe that QE was a big contributor to a lot of the wealth and income inequality that we see in the country. But maybe you agree or disagree. It's neither here nor there. We know it exists. We can observe it. We can look at our Gini coefficient. We can look at different distribution changes in the distribution of share of income, share of wealth, et cetera. And if we were about as unequal as we were prior to the Great Depression, there's no pick your metric. And so I happen to believe that part of the response that we're having from a fiscal situation perspective, whether it be the populism we've seen on the right, we obviously have populism on the left, in terms of both the Trump and Biden administrations. All roads basically lead to like $1 trillion, $5 trillion budget deficits, for the foreseeable future. Whether it be blowing a hole in the tax collection or blowing taking spending up too high, but it's all going to more fiscal, more fiscal, more fiscal. And as a function of more fiscal, more fiscal, more fiscal, we're probably going to have less monetary, less monetary, less monetary, right? And so you think about the kinds of companies that have historically really worked for VC investors, or have been the kinds of companies that user growth is really the only thing that matters. Get to scale, get to marketability, burning cash flow is not really that big of an issue. And to your point, you're saying, hey, look, we're actually having this discussion already in the industry, which is actually, it's refreshing to hear, because it sort of aligns with my worldview, which is we're going to be in a world where fiscal authorities are in control and in charge of the ship, which means monetary authorities are going to have to clean up the mess, and they're cleaning up the mess, which is what we're observing in 2022, which is higher interest rates, higher balance sheet policies. And so I go back and I think, like, is the opportunity set going to change for you guys, right? Like, that to me is different. Like 5 years from now, let's say we're in a world that's higher, like everything we think about the world, at least 42 macro, which is higher inflation, more fiscal, less monetary. If we're in that world for the next 3 to 5 years, does the opportunity set for that $290 billion of dry powder change? Like, how do you think that might evolve? Like, what was VC like in the 70s, basically, is what I'm really trying to ask.
Yeah, I mean, I think it's going to change significantly, depending on who the target audience is for a lot of the VC-backed companies are. So to make that more concrete, if a company is going after consumers, so B2C, right? We know that consumers are going to become much more cautious in light of a recession, in terms of like higher interest rates, their mortgages going up and all those kinds of things. So it's going to be a lot harder to extract that marginal dollar from that consumer who is really under really tight pressure. And so the kinds of companies that will be successful are those that consumers see tremendous value from, such that they have to purchase this product, or something that saves them a lot of money and helps them be nimble with their finances or their ways of working. So in other words, it's going to be really hard to extract that extra dollar from that business. When it comes to the B2B side, businesses I don't think are going to struggle as much, especially in the middle sort of bracket of things. But businesses are also going to be cautious of this, because at the end of the day, the ultimate customer of those businesses is the regular consumer in many cases. But I think from a B2B perspective, it's going to change. Companies are looking for cost-cutting reduction measures, or things that can improve their top line or growth, much like consumers are. But I think you're going to have to justify investments with much more tangible sort of calculations, trade-offs, and things of that nature over the next couple of years if you're in the B2B space. And I think it's going to end up being where companies are going to go all in on a few sure bet winners, as opposed to kind of using a hodgepodge of different kind of startups or different kind of investments, as opposed to them using sort of one core company or one core value proposition from a particular user. So anyway, I think it's going to be pretty interesting and pretty different over the next couple of years. But it bifurcates when you look at B2B versus B2C significantly. And then, as I mentioned before, profitability. At this point in time, if you're profitable and you can show sustainability, you're going to get so much money thrown at you. It's incredible. If you can't show that right now, then I think there's a different discussion that's going to be had. But yeah, in the 70s, back in the day, there was much less competition. People didn't even know about VC. There was like a handful of them. There were a bunch of guys in Silicon Valley that pooled money together and invested in some companies. But now everyone wants to be a VC. You see all these platforms where, you can put $1,000 check into a startup. So people are realizing that they have to create passive income streams for themselves. And they're thinking, if I can invest in the next Google or the next Uber or whatever it is, I can either start to see my $1,000 check 10x or 100x in 5 or 10 years time, which helps me keep up with my spending patterns. I'm pretty sure you know about the wealth effect, but it's like my house has gone down, everything else has gone down. I need to invest in an asset that helps me escape this inflation nightmare I'm in. VC is one of those avenues because historically we outperform S&P 500, all these types of things. So you're going to see a lot of average consumers investing in startups that they think are going to be the next Google, and they're happy losing half their investment. All they need is 1 or 2 big winners. They can get that $100K, $1 million check, and then they feel like, okay, they can breathe a little bit. So all my friends, everyone is speaking about it in conjunction with sort of the meme stock frenzy that you heard about and all that kind of stuff. But I think VC is being democratized to an extent I've never seen before. Everyone wants to be a VC. Everyone wants to invest in startups, and they're okay to actually lose because this millennial generation has a very different risk tolerance compared to boomers. We're not doing the traditional 60-40. All that's out the window because for the first time in history, I think bonds and equities have both struggled at the same time, which is not really usual. So now it's all about, can we get that one or two big wins or exits that can help us outpace inflation and do well? So hopefully that kind of answers your question.
No, it does, man, because I've seen it. You brought up the millennial sort of risk tolerance, and one thing I've seen, this sort of YOLO mentality, this YOLO culture, in my opinion, I think it dates back to kind of the origins of this QE era, right? Like most millennials, were probably not old enough to have a significant, nest egg, back in 2009, or they weren't able to buy S&P 500, 600 something, or Bitcoin $0.00. Yeah. And so everyone, as a function of watching sort of asset markets, appreciate, and really not having a real significant generational buying opportunity like previous generations have had, like the Gen Xers. If you had money as a Gen Xer, you could have bought every asset you wanted in 2008. You had every money as a baby boomer, you could have bought every asset you wanted in 2002, right? Like there was all these big opportunities to buy, but we have not had that. And so I think millennials and certainly Gen Zers, I feel like they got to catch up. It's like take as much risk as possible because we don't get these opportunities. We had a Fed that was so interventionist. I think that the interventionist Fed is probably a thing of the past, or at least relative to what we have used to experience. So you might actually start to see more normal, I guess, market conditions that would allow you to have some big investments. I do just as an aside, I do worry because both, and this is a dirty secret in finance, but I'll tell you, institutional investors are just as momentum junkies as retail investors. Mm-hmm. They see an asset class that works, they want to flow funds into it. They see a fund that works, they want to flow funds into it. And every empirical study shows that if you're Fund A, you're in the top quartile or top decile performance, the probability of you being in the top decile performance year 1 from now, year 3 from now, year 5 from now is low. Yeah. Same thing with different asset class returns. But anyway, we're humans. We like winners and we don't like losers, so it's pretty abnormal. So that behavior you're observing in terms of everyone wanting VC, it's the same thing we're observing institutionally as well. Everyone wanted private equity, everyone wanted VC. But the reality is I wonder, just the natural contrarian in me as an investor says, man, usually when everyone likes something, it usually doesn't work, right? Like the time to want stocks is March of 2009 when everyone thinks the world's going to end, right? Yeah. Or April or March of 2020 when everyone thinks the world's going to end. The time to not want stocks is January 2022 when everyone thinks everything. Well, it's not even January 2020. I would say January 21 was even more bullish. Like January 21, it's like, man, everything's fantastic, recovery, and things are great. And then you look at one by one, small caps peaked in, crypto peaked shortly after. Kathy Wood peaked back then, but it didn't feel like they were peaking because everything was fantastic, right? Yeah. And so, to me, it's the natural contrarian to me says, if everyone wants VC because VC has done really well in the most recent, market cycle, it's probably not going to be the best risk-adjusted return relative to what a lot of people expect. It might still have high returns relative to the broader equities and stuff, but to me, it just says there's a lot of money chasing a lower return profile. When that happens, you tend to get negative returns or bad returns.
And speaking of dirty little secrets, that's kind of what's happening in VC as well. So everyone has accumulated money over the past 2 or 3 years. And when I say everybody, I mean institutional players in the VC space have accumulated money, waiting for the downturn for valuations to drop off a cliff. And then they're all going to pile in. So I'm guessing 2023, 24 will actually be a good year in terms of the amount of money that's going in. But the individuals who are maybe not as sophisticated, they don't know how to time it per se. They see a good opportunity, they just put money in. So I forecast that a lot of people are going to lose money. But it's the same thing with the meme, the Robin Hood. People are actually okay with losing money. They're willing to take that risk and say, I lost because I played the game, but I wanted to at least have a chance to escape the rat race of this inflation world or this high asset world where I can't even get on the housing ladder and all those things. At least let me have a shot at success. So yeah, a lot of people are going to suffer. I hate to say it, but that's where institutions are going to sweep in and pick up assets on the low or on the cheap within the next 12 to 18 months. Once people are out of jobs and things of that nature, startups are really starved for cash and things of that nature. So yeah, it's a very topsy-turvy world we're going into, but that presents opportunities at the same time. If you have a sharp eye and you have a good network and you really know what you're doing, I think some people will do well. A part of me, though, I have to admit, is a bit concerned that we might go into, I don't want to say the D word, like a depression, but almost like a monetary reset. And it's because the US economy is mostly consumer spending. Consumers are kind of tapped out right now. The real wages have not gone up in 30 years. I mean, they're down this year, I think like 2 or 3% compared to, inflation. So it's like at some point, the consumer is going to tap out significantly and there has to be a monetary reset. But that just might be the doomsday guy in me. I don't know.
Well, it's fashionable to be a doomsday person this year. I have a little bit more of a sanguine view on the economy. I think recession is a very feasible outcome by the end of this process, this tightening process. But we just don't have the leverage cycle dynamics in the economy that would perpetuate a real deep, nasty recession. Now, if the Fed overdoes it just by a tremendous amount, then obviously all bets are off. But I gotta believe that just based on some of the early signs on what they're looking for to get out of this regime, I think they're going to see what they need to see before they truly and just put us in a depression or doomsday scenario. But that doesn't mean a recession is not. A recession is a good thing, by the way. We're a capitalist society. Yeah. And recessions help us reallocate capital. They give people an opportunity to invest. Would you rather buy a house that's up 30% year over year or a house that's down 10% year over year?
Exactly.
Right? It's so it's funny. Like we treat everything in life very differently than we treat investing. We go to the grocery store, we want a good deal on everything we buy, but then when it comes to investing, we run for the hills when we see good deals in the markets. And so I find that to be very fascinating. But we know that's behavioral. That stuff won't change. Kind of I guess my parting thought on all this it's you mentioned something that I think is very important to sort of end on, which is this is an era for active management. I think the number one thing that is very clear from our perspective in terms of the models that we built, in terms of projecting things like the longer run mean of inflation, the equilibrium interest rate, stuff like that, all this wonky academic stuff that most people listening to this don't really care about. We're going from a state of a lot of those indicators that was extremely favorable for asset markets, particularly risk asset markets. At the bare minimum, we're going to a state that is probably neutral. And it's my belief that we're going beyond a state that's neutral in terms of the steady state equilibrium of monetary policy, fiscal policy, of interest rates. All these things are probably going to be adverse, which means the opportunity set of investors is going to be smaller, which means you're going to need thoughtful, active managers to go actually find those opportunities and take advantage of those opportunities, as opposed to just being long beta. There's a ton of opportunities because everyone's got cash and every VC can capitalize every business. You don't need a smart VC manager. You do need a smart VC manager or macro guy in this, or guy or gal in this particular world, because again, that opportunity set in terms of the total amount of return we should expect on an ex-ante basis from financial markets is going to be lower in this next decade.
Absolutely. Couldn't agree more. Well, thanks so much for being on the show, Darius. We'll have you back for another episode, I'm sure.
Love to.
Thank you so much.
Appreciate you, Saka. This is awesome, man. You're doing great work, man. Keep it up.
Sounds good.